This week in economics on the 30th of October 2015. Numbers man here. Number of reports coming out from the federal government, and we'll get to that in a minute. We'll start this off with the Michigan Consumer Index, and we'll go to it first. And then we'll get the stuff from the Department of the numbers from the Department of Commerce, etc. Nonetheless, the index of consumer sentiment was 90.0 compared to 87.2 in September of this year and 86.9 in October. A change there is a plus 3.2%. The current economic conditions, that index, at 102.3 in October and 101.2 in September. In October of last year, 2014, 98.3. It changed as a plus 1.1%. The index of consumer expectations at 82.1% in October and 78.2 in September, and last year it was 79.6. That is 5%. A month-on-month change. I should have put that out. The 1.1% was month-on-month also, and the 3.2% was month-on-month. If we go to year-on-year, we basically have 3.6 change there for consumer sentiment, and current economic conditions 4.1 is the change there, and 3.1. From Dr. Curtin, the entire October rebound from September was due to gains in confidence among lower-income households, while confidence among households with incomes in the top third of the income distribution retreated a bit due to concerns about the financial markets. Nonetheless, the overall impact from volatile stock prices have been quite small. Indeed, the average level of sentiment index through 2015 has at 93.1 is higher than any year since 2004 at 95.2. More importantly, future economic prospects were viewed more favorably by households in October than any time since 2007. That was the beginning of the Depression. In addition, the expected long-term inflation rate dropped to its lowest level in over a quarter century. That's 25 years. Well, these favorable trends will keep the pace of growth in consumer spending at 2.9 in 2016. Consumers will continue to make increases in their buying plans, contingent on the availability of price discounts and low interest rates. And indeed, it was consumers' disappointment with available price discounts that was responsible for a small retrenchment in confidence in the last half of October. Now let's go to personal income outlays. This is from the Bureau of Economic Analysis. Personal income outlays in September 2015. Personal income increased to $18.6 billion, or 1/10%. Disposable personal income increased $19.2 billion, or 1/10% in September. Personal consumption expenditure, that's PCE, increased to $15.6 billion, or 1/10%. In August, personal income increased $54.9 billion, or 4/10%. The DFI increased $49.5 billion, or 4/10%, and the CPE, that's the personal consumption expenditure, at 44.2, or 4/10% based on revised estimates. The real DFI increased 0.2% there. And if we look at some of these outlays, we start in May on personal income, current dollar at 4/10, and then in September at 1/10. Disposable personal income in current dollars, it was at 4/10 in May, and it ended at 1/10 in September. Personal consumption expenditures 9/10 in May of 2015, and 1/10 in September. And let's go to compensation. Wages and salaries decreased 3.7 billion in September, in contrast to an increase of 38 billion in August. Private wages and salaries decreased 7 billion, in contrast to an increase of 32.2 billion. Government wages and salaries increased 3.3 billion, compared with an increase of 3.8 billion. Supplements to wages and salaries increased 3.3 billion in September, compared with an increase of 6.4 billion in August. Proprietors' income increased 5.6 billion in September, compared with an increase of 0.6 billion in August. Farm proprietors' income increased 2.6 billion, the same increase as in August. Non-farm proprietors' income increased 3.1 billion in September, in contrast to a decrease of 2 billion in August. Rental income persons increased at 2.5 billion in September, compared with an increase of 1.8 billion in August. Personal income receipts on assets, personal interest income plus personal dividends income increased 5.7 billion, compared with 5.1 billion in August. Personal current transfer receipts increased 4 billion. And that would be in September, compared with 9.5 billion. Contribution from government social insurance, a subtraction in the calculation of personal income, decreased 1 billion in September, in contrast to an increase of 4.4 billion in August. Personal current taxes and disposable personal income decreased 0.6 billion in September, in contrast to 5.4 billion in August. Disposable personal income, that's the DFI, less personal current taxes, increased 19.2 billion, or 0.1%, compared with 49.5 billion, or 0.4%. Personal outlays, personal savings. We look at this very, very carefully here. 15.7 billion in September, compared with an increase of 42.3 billion in August. The PCE increased 15.6 billion, compared with an increase of 44 billion in August. Personal savings, that is the DFI less personal outlays, was at 642.8 billion in September, compared with 637.3 billion in August. A little better. Personal saving rate, personal savings as percentage of disposable income, was at 4.8% in September, as compared with 4.7%. Or very little change there, compared with personal savings in the Bureau of Economic Analysis, national income, product accounts with personal savings in the Federal Reserve Bank, financial accounts, etc. Real DPI, adjusted to remove price changes, increased 0.2% in September, compared with an increase of 0.4% in August. Real PCI, adjusted to remove price changes, increased 0.2% in September, compared with 0.4% in August. Purchases of services increased 0.3% in September, compared with 0.4% in August. The price index for PCE decreased 0.1% in September, compared with less than 0.1% in August. And some of the revisions here were out here. Personal income, current dollars, it was previous at 0.3%, now it's 0.4%. Disposable personal income is the same, 0.4%. And personal consumption expenditures at 0.4% and 0.4%, so nothing new there. So that will take care of that part of the puzzle. Let me just move on here. National income and gross product purchases, the third quarter. This is the this is the advance estimate. Sorry about that. According to the advance estimate released by the Bureau of Economic Analysis. In the third quarter, real GMP was at 3.9%. The emphasis in the third quarter estimate released today is based upon source data, are incomplete and subject to change, no doubt about that. The next report will be on the 24th of November 2015. Here, and let's see, real increase in real GMP. Real GMP increased 1.5% in Q3 after revision of increasing 3.1% in the second Q2. Real gross domestic purchases by U.S. residents, etc., compared with an increase of 3.6 in the second quarter. It was 1.5. Current dollar GMP, that's the market value of goods and services produced by the nation's economy less the value of goods and services used up producing it, increased 2.7%, or 121.1 billion in Q3, to a level of 18 trillion 034.8 billion in the second quarter. Current dollar disposable there. Current personal income increased 171.6 billion in Q3, compared with an increase of 139.5 billion in Q2. Personal current taxes increased 155.9 billion, or 4.8% in Q3, compared with an increase of 112.2 billion, or 3.4% in Q2. Real disposable personal income increased 3.5%, compared with an increase in Q2 of 1.2%. Personal outlay increased 136.6 billion in Q3, compared with an increase of 182.3 billion in Q2. And the saving disposable less personal outlays was 636.7 billion in Q3, compared with 617.5 billion in Q2. Personal savings rate it was 4.7% in Q3, compared with 4.6% in Q2. A little bit better there. So that will do that particular statistic in. We have a statement here from the Fed. I'll have to find it on their meeting on Wednesday. Basically, the increase will be on the table, and I'll just hit the high points here. This is released on the 28th. Information received from the Federal Open Market Committee met in September suggests that economic activity has been expanding at a modest pace. Household spending and business fixed investment have increased at a solid rate in recent months, and housing sector has improved further. However, net exports have been soft. The pace of job gains softened, and the unemployment rate held steady. Needlessly, the labor market indicators on the balance sheet that the underutilization, and this is one of the things the Fed looks at, of labor resources has diminished since early this year. Inflation has continued to run below the committee's expectation, as 2%. Consistent with statutory mandate, the committee seeks to foster maximum employment and price stability. The committee expects that with appropriate policy accommodation, economic activity will expand at a modest pace, and with labor market indicators continuing to move towards the levels the committee judges consistent with its dual mandate. And that's very important to remember, the dual mandate. The committee continues to see risks to the outlook for economic activity and the labor market as nearly balanced, but is monitoring global economic and financial developments. Inflation anticipates to remain near its recent lows in the near term, but the committee expects inflation to rise gradually towards 2%. In our opinion, 2% is really too low. To support continual progress towards maximum employment and price stability, the committee today reaffirms its view that the current 0 to a quarter point target range for the federal fund rate remains appropriate, and determine whether it will be appropriate to raise the target range at the next meeting. That'll be in December. The committee will assess progress both realized and expected towards the objective of maximum employment and 2% inflation. The committee is maintaining its existing policy of reinvesting principal payments from its holdings of agency debt and agency mortgage-backed securities in agency mortgage-backed securities and rolling over maturing treasury securities at auctions. This policy, by keeping committee's holdings of long-term securities at a sizable level, should help maintain accommodative financial conditions. When the committee decides to begin to remove the accommodation, it will take a balanced approach. The key here, consistent with long-run goals of maximum employment and 2% inflation. The committee currently anticipates that even after employment and inflation are near mandate consistent levels, economic conditions may for some time warrant keeping the target fund rates below the level the committee views as normal in the long term. And voting for this, Chair Yellen, Dudley, Bernard, Evans, Fisher, Lockhart, Powell, Toronto, and James Williams. Voting against it was, of course, Jeffrey Locker, who prefers to raise the target rate for the funds rate by 25 basis points. That was at that meeting. So that is where the Fed is, and we'll go on to the BBC to wrap up the global part of our little puzzle here. We will go there to the BBC in a minute here. But firstly, the accommodation is the key, and they will move in that order. And as far as inflation is concerned, inflation is very, very low. As an example of this, the BBC has Exxon and Chevron. Low oil prices hit those particular enterprises. Exxon, remember them, reported 3-month profits at 4.24 billion. Is 2.76 billion pounds. That's down 47% from last year. Chevron's profits fell 67% to 2 billion billion there. So profits from refineries almost doubled to about 2 billion, while profits from getting oil out of the ground fell 79, almost 80%, to 1.4 billion. Exxon oil and gas production grew at 2.3% to 3.9 million oil equivalent barrels per day, while Chevron's fell 1% to 2.5 billion for Chevron. Now let's check the rest of the news here. London, world's worst property bubble, it says here. London properties most overvalued in the world, warns UBS. The Real Estate Global Bubble Index, UBS, says that any city scoring more than 1.5 is at risk of a bubble. It says all rates of property prices to income and property prices to rents have reached all-time lows, all-time highs. This is in London. And that makes London one of the most expensive cities in the world. This is what happens when speculation goes amok. Over the past experience, USB said that the price correction of 30% usually occurs within 3 years of the index exceeding 1. New York, Boston, Chicago were among the cities at least risk of a housing bubble. Very interesting there. And this particular index, and I'll look at it real quickly here. We have time. This is UBS's index. Research global perspectives for local expertise. Well, anyway, this is a municipal brief, not really what we were looking for here. Dealing with Puerto Rico, incidentally, Puerto Rico's debt, there are indeed problems there. And we'll have to look at it further. Let's see, this actually gave me the wrong page here. Okay, overweight stocks versus bonds, favoring the Eurozone, Japan and U.S. Camps. And they're not going to give us that information. Anyway, we'll take that word that the bubble is bubbling along there, and global real estate bubble index, one of many factors out here, and world's riskiest city here, and this is again at CNBC, who is defrocked from the Republican debate cycle. With will near history repeat itself? No, history does not. UBS says properties in all European cities now exceed fair valuation, with London the most overvalued market on the continent and the city most at risk of a bubble. The UBC index, London's prices in real terms, are 6% above their previous peak in 2007. The world's least affordable Hong Kong, which ranks as the second city most likely to hit a bubble. Property exacerbation. With the exception of London, is well known. Europe may be surprised to learn that Amsterdam, I'm not surprised, that is rated the second most susceptible city on the continent to housing bubble. The German Finance Center in Frankfurt also described as on the rise, on the trajectory in overvalued territory. Zurich and Paris, additional highlights of overvalued at Geneva thrown in. And let's see, Albert Gallo, he's the head of the European macro credit research at RBS, sent out a note Wednesday that an Australian bank could be at risk for housing price there. And further, Deutsche Bank, who is laying off thousands of people, also warned a boom in global property prices driven by loose monetary policy across the West, with policymakers in Japan and Europe all contemplating further stimulus measures. Beyond chatter, how important the expansive, impossibly expansive the likes of London and New York have become, the topics draw far less attention than it merits from policymakers and investors. They're looking at some cities here: Tokyo in Japan, Vancouver in Canada, were also designated overvalued by UBS. In addition, the Prime Minister of New Zealand discussed the rising prices of there. So actually, in actuality, we see it all over the place. It's a kind of an equal opportunity type of situation in Europe. Just grab one other thing here. Why investors are shorting the Canadian housing market. They recently had an election there. A growing number of investors are betting Canada's for if the property market, will nosedive, according to research from Market. We usually use them. Investors are taking an increased number of soft positions on banks and insurers with high exposure to property. That's Market explained, with investors expecting share prices to slide. This comes amidst low interest rates in the country, which have been cut twice this year to 0.5%. Financial groups now account for 3 of the top 10 shorted stocks in Canada. Home Capital, one of Canada's largest financial institutions, currently ranks as the most shorted stock in Canada. Home Capital Group recently saw 18% share sell-off, and the cost to borrow of its shares jumped 10%. That's according to Market. That follows closely behind Canadian West Bank, which has 54% of its $19 billion portfolio in real estate, personal loans, and mortgages. Not a good deal. About 27% of its shares are on loan, making it the 4th most shorted stock in the country. Genworth, which underwrites private residential mortgages, MI, has not seen the stock slide. Has not only seen it slide 22% in the last 12 months, but the numbers of short holdings increased to 19.3%. Really a problem there. Short sellers have been trying to call the top Canadian property market for years now, but they have proven to be a tricky trade, as continual cheapness of credit has continued to propel local demand and prices. That's an analysis from Market's Renette Shuffles there. Data from RBC Purchasing Managers, another index here, clocked the sharpest decline in Canadian business conditions in the survey's history. In September, the weak demand and stagnating exports helped the PMI reading to 48.6, a very low place there. And these indexes out here, a lot of them we use Markets. We haven't used RBCs, but we'll look at it here. And let's see, in association with a Market, here is part of their index. And this is Canadian manufacturing PMI. This is the 15th of October. Let's see, manufacturing PMI. Well, we can grab it really quickly here. And this is from Toronto. This was on the 1st of October. And the weakness was already there. Production volumes declined for the 2nd month running. Renewed fall in new business levels. Survey record reduction in input buying as manufacturers sort with their inventories. So you kind of see the condition of where Canada is. And let's move on here. Deutsche Bank to cut 15,000 jobs. So on the 28th there, from the BBC, 15,000 people made redundant at Deutsche Bank. That's the largest bank in Germany. Said it would cut 19,000 full-time jobs, 6,000 contract jobs. Their shares fell 5%. Cuts in Germany. The bank also plans to spin off Postbank. We've talked about that before. That is in Germany. So you can kind of see the global situation shaping up here. Sharp's operating profits fell 86%. They are manufacturers of electronic parts. Fell to 3.5 billion yen. There, it's the second quarter from the 24.5 billion yen a year earlier. They announced that they also were cutting jobs. The company has been under pressure from its lenders to sell loss market LCD business there. Not what it used to be. That is Sharp. And their profits obviously went south on them. And from the BBC, and just a headline here, we already talked about this. The U.S. economic growth slows sharply, is the here, and we went into gross domestic product grew at an amortized pace of 1.5% between July and September, down from a rate of 3.9 in the second quarter of Q2. And the analysis here, well, we'll go ahead and give this. This is Andrew Walker. Yes, sharp slowdown compared with previous 3 months, but the biggest reason for it was companies running down stocks, meeting demand by selling stuff they already had in the warehouse. That is a process that has a limit. Sooner or later they will feel they've sold enough and may have to start replenishing. Well, maybe. We're getting to all-important holiday season coming up later in November. Consumer spending remained fairly robust. It grew at 0.8 for a 3-month period, or 3.2 in amortized terms that U.S. officials statisticians prefer. Well, there are different ways of doing this, but if we look at it 0.8 in 3-month period, there is not very good. The headline numbers isn't great, but this masked underlying strength. That's from Luke Bartholomew. He's at Aberdeen Asset Management. Analysts say the running down of warehouse stockpiles in Q3 was likely to be temporary effect, and they expect growth to accelerate again in Q4. Well, that is maybe not. The Fed has said in past days it expects it to raise the interest rates in 2015. Well, that will depend on a number of things. Inflation at this point is very low, and the Fed is waiting and seeing in December. Now, at their December meeting, they'll have in the holiday consumer buying, and then they can see exactly where they are. We'll go ahead and do the markets now. Actually, we'll get the market data here. And the stock markets. This is on Friday unless otherwise noted. And we'll start out here with the BBC Global 30. It was down 85.86 or 1.15%. The FTSE was down 15.26. In Amsterdam, they were down 0.87. In Frankfurt on Friday, 49.30. In Paris, 11.84. In Brussels, 15.18. They were down in Madrid, 36.50. In Zurich, they were also down 18.62. In Moscow, 2.93. In Johannesburg, they were down 294.82. In Bombay, they were also down on Friday, 181.30. In Karachi, down 70.83. In Lahore, 9.39. In Colombo, they were also down there, 28.07. And in Tehran on Wednesday, 0.70. In Sydney on Friday, they were down 21.60. The Nikkei, 147.39. The Hang Seng was down 179.90. In Shanghai, they were also down on Friday, 4.75. In New York, they were down 92.26. The Nasdaq was down 20.53. The Merck was down 10.005. In San Pablo, they were at 240.47. And finally, in Mexico, they were down 92.05. Look at commodities here. Brent crude was up 72 cents at $49.52. The spot, the futures here were up 36 cents at $49.18. West Texas Intermediate was up 35 cents at $46.14. That is a 0.8% rise there. Cocoa was up $44. Gold on the Forex was down $11.25 at $1,147.75. Dubai Gold futures were down $5.90 at $1,141.10. Silver was down 19 cents at $15.63. The Euronext Life futures. Cocoa was up $4. Robusta coffee was up $50. Sugar was down $1.30. And milling wheat, no change there. Corn was down $1.50. The Bloomberg Commodity Index was up 56 cents, or 0.7 at 87.43. This will do it for us, as played out from the Bureau of Economic Analysis. The consumers have indeed kept their eye on the prize, so those in business make next week a productive one in a, as one would say, an economic environment that could be challenging. We'll know more about that in about 2 weeks as the holiday season starts in earnest. And we expect that the discounters will be discounting, and if the consumers are waiting on discounts, they will find some. And there are various boycotts out there for the Black Friday, Cyber Monday, etc. It'll be interesting to see how the boycotts, how effective they are, but also will the consumers, as soon as retailers start to discount, will they run out and grab these? Or will the retailers play a discount game of one, who knows, 60-inch TV or 70, wherever they are, 80 per store or per region, and people will be in the long lines? Or will Amazon and company start to use the drones to drop these TV sets? Who knows? Have a good weekend, everyone. We'll talk to you next week.